It's been a wild few weeks on Wall Street. The same tech giants that powered the market's rally all year, Apple, Nvidia, Microsoft, Tesla, and Amazon, are suddenly the ones pulling it down. The Nasdaq Composite, long seen as the barometer of America's tech-driven economy, has taken a sharp hit. So what's going on? Why are tech stocks tumbling? And more importantly, should you be worried? Let's start with the backdrop. For much of the past 2 years, tech has been unstoppable. Artificial intelligence fueled optimism. Big companies posted record profits. Investor enthusiasm pushed valuations higher than ever. But now that story is colliding with a much tougher reality: slowing growth, rising competition, and investors rethinking what's actually worth paying for. The Nasdaq's drop isn't random. It's the result of a perfect storm of factors hitting tech all at once. First, interest rates. Even though the Federal Reserve is signaling potential rate cuts next year, borrowing costs are still at their highest in over 2 decades. And for tech companies, especially those valued on future growth, higher rates are poison. When money costs more, speculative bets lose their shine. Investors shift from potential to profit, from growth stocks to stable ones. That's why you're seeing a rotation into sectors like energy, industrials, and healthcare, and a pullback from high-flying tech. But rates alone don't tell the whole story. The second factor is earnings reality. For the past few quarters, tech companies have been reporting solid profits, but not enough to justify their sky-high valuations. Investors were pricing in perfection. Anything short of spectacular has been punished. Take the latest round of earnings. A few companies beat expectations, but their stock prices still dropped. Why? Because the market had already priced in even bigger numbers. It's not just about how much money these firms are making, it's about how much more investors think they should be making. And that gap between expectations and reality is widening fast. The third factor, AI fatigue. Last year's market boom was built on one word: AI. Every company, from chip makers to software firms, rode the wave of artificial intelligence hype. But now the market's asking for proof. Where are the real profits from AI? Are businesses actually seeing productivity gains, or are we still in the spending phase? Many companies are pouring billions into AI infrastructure, data centers, chips, and cloud systems, but those investments take time to pay off. So while the narrative around AI remains strong, the short-term returns are still uncertain. Investors are realizing that transformative doesn't always mean immediate. Then there's the global factor. China's slowdown is weighing on tech exports. The ongoing chip trade tensions between Washington and Beijing are creating uncertainty for companies like Nvidia and Intel. At the same time, Europe's new tech regulations and US antitrust actions are putting pressure on giants like Google, Amazon, and Meta. When you combine all that, high rates, high expectations, AI uncertainty, and global headwinds, you get exactly what we're seeing now: a market correction driven by nerves, not necessarily by collapse. And that brings us to the question, should you be worried? The short answer, not necessarily. The longer answer, it depends on what kind of investor you are. For traders looking for quick gains, this environment is tough. Volatility is up, sentiment is fragile, and algorithmic trading amplifies every move. But for long-term investors, corrections like this are part of the cycle, and often they're healthy. Because behind the red charts, something important is happening: a reset of expectations. Tech isn't dying, and it's normalizing. The companies leading this market are still incredibly profitable. Apple still generates over $20 billion in quarterly net income. Microsoft's cloud business is growing at double digits. Nvidia is still selling out its chips as fast as it can make them. The fundamentals are solid. What's changing is the pricing. After years of relentless optimism, the market is finally asking the hard questions: what's sustainable? What's overpriced? What's next? And that's good. Because bubbles don't burst from corrections like this. They deflate, stabilize, and pave the way for more realistic growth. Think back to history. The dot-com crash of 2000 wiped out countless speculative startups, But it also cleared the field for the real tech leaders of the next decade: Google, Amazon, and Apple. The same thing could be happening now, a moment of separation between the hype and the hard value. There's another dynamic to keep an eye on: capital reallocation. Institutional investors, pension funds, mutual funds, sovereign wealth funds, are diversifying out of tech and into sectors that have lagged for years. Manufacturing, infrastructure, clean energy, even defense. These industries are attracting new interest as Washington spends heavily on industrial policy and reshoring initiatives. In other words, money isn't leaving the market, it's moving around. That's why analysts say this NASDAQ drop isn't a crash, it's a repricing. A pause after an extraordinary run, and importantly, it's not uniform. Some smaller, more specialized tech firms are still rising, especially those working in quantum computing, cybersecurity, and advanced semiconductors. Because while investors are cautious, they haven't stopped believing in technology's long-term story. They're just choosing to be more selective about which part of it they're buying into. Still, there's one thing worth watching closely: consumer demand. Tech spending depends on confidence, from businesses, from consumers, and from governments. If the broader U.S. economy starts to slow, if job growth weakens or consumer spending dips, even the best tech stocks could struggle. For now, though, the economy remains resilient, inflation is easing, unemployment is low, and corporate investment, especially in AI and automation, continues to climb. So yes, the NASDAQ is down, but in many ways, that's the market catching its breath after an incredible sprint. Because every boom needs a pause, and every pause creates opportunity. In the end, what we're seeing isn't the end of the tech story. It's just the next chapter, one where results matter more than promises, fundamentals matter more than forecasts, and value takes the lead over hype. So don't mistake turbulence for trouble. Markets correct, technologies mature, expectations reset. The NASDAQ may be falling today, but if history is any guide, that's exactly how the next wave of innovation begins.